So first, want to start off with another thank you to Volt Capital and CMT. Events like this, really important. We need to continue to evolve and kind of spread the crypto narrative, really start to bridge the gap with traditional markets. So thank you again, Volt and CMT, for the efforts that you both are doing. We are here to talk about how startups are approaching the next generation of finance. Quick intro from me, and then we'll get to intros on the panel. So I'm Scott Sigel. I head business development for Arwen. See if my colleagues are still in the room. I don't see them. So what Arwen is doing, just quick spiel, since we are local, we're a Boston company, funded by Underscore VC, who is also in the room here somewhere. We are creating settlement solutions that are using the blockchain. So we're looking for ways that we can actually move capital more efficiently, more securely, eliminating elements of risk between custodians, between platforms. So looking at how we can actually change the nature of settlement, which is an area of finance that hasn't really necessarily seen a lot of evolution over the last few decades. So if we want to run down the panel and do some intros.
Yeah, I'm Konstantin. I've spoken earlier. I'm the founder and CEO of Blockdaemon. I think all I'd say is that we run nodes for the companies that build stuff on top of chains, as well as for investors who really should and are contributing to the network in terms of submitting and extracting transactions. One thing I always like to state is so nodes are really the actual ledgers. They're the little databases that weave a block and contain a full copy of the blockchain. The networks, any blockchain lives and dies by the quality and amount of nodes in a network. When we talk about decentralization, what we mean is nodes run by independent individuals around the world in independent data centers. And so that's the core foundation any financial product or anything we do in this space is built on. And we help people do that.
Thanks very much. My name is Samir Ghosh. I'm the head of growth at FalconX. I'm very excited to be here, guys. This is actually our first public appearance and event. Very quickly on ourselves, we are an institutional digital asset brokerage. We deal on clients' behalf across global liquidity sources, exchanges, market-making firms, dark pools. All of the resources in the company are focused on one thing, which is finding the best price for institutional trading firms in crypto. We've reached a point of scale where we're doing on average 30 to 40% of Coinbase's volume on a daily basis, which would make us a top 3 or 4 exchange if you're measuring us by trading volume in comparison with the exchanges in the market. We hope to soon, obviously, eclipse a lot of the exchanges since we're a brokerage that sits on top of all of them. We're fortunate to be backed by CMT, who's here in the room. Thank you for hosting us. Flybridge Capital, Excel Partners, Lightspeed Venture Partners, as well as strategic partners such as Fidelity, Coinbase, and BitMEX. Pass it over to Dave.
Awesome. Okay. I'm Dave Balter, founder and CEO of Flipside Crypto. Flipside is in the business intelligence offering business. We service actually blockchains themselves. Our IP allows us to do something we call chain walking, which is decoding blockchains and distinguishing between types of stakeholders. So we can distinguish between what miners are doing, what speculators are doing, and what actual users and customers are doing. And we provide blockchains those insights. Think of us a little like Google Analytics. If you're building a website, we teach them how to run their organization. You may know us through our rating system, Fundamental Crypto Asset Score, FCAS, uses that data to produce a fundamental rating for crypto assets. FCAS lives on the street and MarketWatch and StockTwits and CoinMarketCap and a whole bunch of other places. FCAS, to give you an idea of scale, FCAS ratings are downloaded 500 million times a day. They're called, and so they are used by investors to understand fundamental health based on our stakeholder data.
Hello, my name is Mason. I'm the CEO of Tokensoft. So our clients are startups and financial institutions that are issuing security tokens or securities on the blockchain. We don't only help them comply with regulations here in the US, we help them internationally as well. The most countries we've helped our client service is around 50 plus. The number used to be 56, and then countries keep banning security tokens, so it's around 50 now. And our clients are either, they can be startups, they can be issuing, putting their fund on the blockchain, real estate, They could be financial institutions that are looking to do more creative financial instruments on the blockchain as well. So far, we've processed about $500 million through our platform, and our current pipeline is about $3 billion plus. And that's Tokensoft.
So I think some of you touched on this a little bit, but if you want to think about it, considering the audience in the room, that this is a little bit also of a kind of educational event. Is there an equivalent of your company in the traditional space, which I think some of you touched on, but why is your vision necessarily superior or better? Or what are you doing that wasn't necessarily possible in traditional finance?
I mean, I can, I'm an infrastructure tech guy, so the answers I would have, I don't think would enlighten the financial sort of companies here. I think we see ourselves as maybe a combination of Stripe and Datadog, if that rings a bell to anyone. But and we're better because we're more decentralized and handle much more complex orchestration tooling. But
So I'll use two analogs to explain a little bit about what we do and how it's different from traditional finance. The first I'll use is Interactive Brokers. So you may be familiar with the firm. Interactive Brokers built their brokerage on a shift that happened in trading, moving towards electronic trading systems. They were formerly electronic market making firm. They used a lot of that technology in order to package this up and provide it as a service to their clients. Now the reason that they were successful in what they did was fundamentally a result of the fact of market structure. Liquidity in traditional markets is largely concentrated at NYSE, at the NASDAQ. If you're looking to get an equities transaction done, usually best execution means how quickly can you get that done, which means that if I'm an electronic execution provider, I'm going to be better at that if I'm faster. Now in crypto, things look a little bit different in terms of the market structure. Liquidity in crypto is fragmented, which means obviously it's dispersed across various venues, and it is fundamentally unstructured. In the advent of electronic trading, everyone connected via the FIX protocol, and everyone knew how to easily tap into liquidity sources around the world. In crypto, there are WebSocket connections, there are FIX connections. If a mining company is feeding you pricing information, it might come in the form of an Excel spreadsheet, right? What you need to be good at in order to provide best execution in crypto is fundamentally different than what you need to be good at in traditional finance. And it's a result of that market structure. So the analog we often use when we think about FalconX is Google. At the advent of the internet, lots of websites were popping up around the world, and Google had this problem, which was how do we structure a query such that I can look at all this unstructured data and provide a result to my user that is useful information. Similarly, we look around the world in terms of global liquidity sources at unstructured data sets. We filter it, and we fundamentally provide a price that is fillable and better than what you'd get if you simply went to exchanges and other structured venues. So while on the outside, our brokerage might look a little bit more like Interactive Brokers, on the inside, in terms of the way we resource ourselves and the way a lot of our talent's from, it's more from the traditional tech institutions like Google.
Got it. Okay, so two sides of our business. On the business intelligence side, as I said, a little like Google Analytics for web-based companies, we provide insights into customer tracking. So if you're going to build anything, if it's mobile, App Annie, if it's the web, Mixpanel, Google Analytics. In the case of our clients, they don't have anywhere to go. They're building blockchains. They end up, the very nature of the blockchain has obfuscated data, and so they end up doing a lot of guesswork. They're doing the same things that many of you might be doing. They're going and looking at transactions on a block explorer, or they're going to look at price data or supply data, but actually understanding what their customers are doing and why they don't have a source of truth to. So we provide that. On the rating side, we actually work closely with a number of major ratings agencies in the market who are, have spent many years building creditworthiness models to understand how to evaluate assets in a traditional space, but they don't have the capability to do that yet in the crypto space. You could argue there isn't really a realm of creditworthiness for crypto organizations the way a major ratings agency would do it. And so many of these organizations use our data to help them start to build the models that will allow them eventually, we all hope, to produce their own ratings for the market. So if we do what we think we're going to do, you're going to see some of those major ratings agencies produce scores for some of the assets in this space soon.
I've sort of, I think since starting the company in 2017, I've sort of gone through multiple frameworks of what's actually different about securities on the blockchain and what makes them new and different. One way to sort of look at it is to look at the fundamental technology, and it's always such that new technology sort of creeps up into the application layer and changes the way we behave with each other, and in this case with these securities. And so, all these securities are on the blockchain. The first blockchain was Bitcoin, and Bitcoin is peer-to-peer. It's permissionless. It's pseudo-anonymous. It has about 10 of these characteristics. If you take a blockchain and you package it up as a security, a lot of those features go away. And the reason is with securities, we have to know everyone that is holding the security. So we have to take them through investor onboarding procedures that include things like KYC, AML, things like that. And so which are the features that don't go away when you package it as a security? And we help our clients comply internationally with these regulations. And sort of one thing that we notice that sort of transfers to the application layer is the ability for these securities to be transferred internationally. As long as you can automate the compliance requirements in the smart contract, you can have that compliance as these securities go cross-border. You can also prevent transactions from going cross-border. There's something called Reg S, Reg D flowback, which is usually an undesired outcome for an issuer, and with these smart contracts, we can prevent transactions from coming into the U.S. from non-U.S. investors and do things like that. And so one thing is, these are they're more liquid now internationally because we can automate the compliance. The other thing that's sort of different is the blockchain it never turns off, and so now we can transfer these securities 24/7, and so that's sort of something that's new and different. And so that's one framework that we use to sort of see what's amazing about putting securities on the blockchain, because we sort of started this company out of necessity. We didn't know it was going to be a big thing. We just knew that there had to be infrastructure for securities on the blockchain. What's the analog? So as we're building all this infrastructure up, we've had to get a broker dealer. We've had to set up a transfer agent. And what we find ourselves doing is using the blockchain and smart contracts to automate a lot of these compliance procedures or the accounting processes that occur, for example, with dividend payouts and things like that. And so I sort of think of this as not the front end of an investment bank, but it's automating a lot of the back end procedures around investment banking. And in 5 years, we hope to acquire Goldman Sachs. So I would say that's the analog.
So, what do you think, as far as, maybe Samir, might be good to start with you on this one, as far as considering the audience you're serving, what are we still lacking in these markets that are kind of that are necessities to traditional investors or standards? And I'm going to challenge everybody to kind of not necessarily just say regulation, but more specific than that. Like, what are the issues that are the kind of barriers that are beyond your control that you feel like we need to have implemented?
I'll give it a stab. So we serve, our client base are discretionary and systematic hedge funds, prop trading shops, OTC desks, and some what I call sort of alternative trading firms. Generally speaking, when we look at what I consider to be the top tier of asset managers in our client base, there's a complaint that I have the potential to raise additional capital, but I just don't know how to deploy it. And the reason for that, generally speaking, is that the liquidity in the space is not deep enough to date. There are a couple, folks that are trading strategies at scale are doing it at venues where they honestly don't want to be doing it. They're doing it at BitMEX, because the liquidity there is the deepest, and I have a lot of reverence for BitMEX and what they've been able to do in order to advance the space and bring in new capital as a result of the liquidity they're providing. So when I think about gaps in terms of the infrastructure that's available to asset managers in the space, I think it's primarily liquidity. That's from what I've observed.
And just to confirm the question was around what infrastructure is sort of necessary to...
Yeah, like what necessities, standards are missing that are kind of getting in the way of your growth?
Yeah, so I think the way we approached regulations initially was, I'm just going to at least call it out, is we didn't think the regulations would change, and so we tried to plug into them, and so we sort of saw that as a constant. And I think this is true with most technologies. There's always like the fundamental innovation, and then it takes a bit of a layering before the technology can be widespread. It takes a little bit of abstraction before it's easy to use, and before it can sort of spread. And we're seeing that with securities on the blockchain as well. I think when people first approached the space, they thought of it as just the primary issuance and the secondary markets. So you raise the money and then you put it on an exchange. As we've been speaking with regulators and infrastructure providers and sort of trying to figure things out for ourselves, the world of securities is not just really two events that occur. There's more like 10 different parties that are operating together to make the whole make all the infrastructure possible and make these stocks easy to buy and sell. And so I think from our perspective, we're about a third of the way through that process, and part of it is just that these securities take a really long time to get through the door, especially when it's on new infrastructure. And I think there's definitely a long road ahead. Things like clearing and settlement are still unknowns in the world of securities. And we're hoping that our transfer agent sort of solves one of those pieces of the puzzle. But there's definitely a lot left to dig into with securities.
Yeah, and I'm just going to take it a little back to basics. Like the interesting thing for us is, so our customers are, the actual protocol foundations, like the things that, people trade, like the projects that actually need to run and orchestrate nodes in order to ensure that the network is secure and operates, as well as the first generation large scale investors like Andreessen Horowitz and folks like that, right? And so, and I think one of the things that people maybe need to understand better is that we, compared to the internet, you have the opportunity to participate in the protocol layer of what we're building here. And it's kind of a requirement for these networks to function and scale. So financial participants of large volume in those respective networks are should ideally really be incentivized to also provide compute power and security to the network. And so it's a little bit of a paradigm shift, but it's something that I think has to become more important. Like this morning I heard, we talked about Bitcoin, and Bitcoin actually, is at a fairly fragile state from a development perspective at this point. I think we have around 5,000 nodes that are fully updated. Fairly poorly distributed around the world. It's not perfectly safe nor scaled at this point in time, even though there's so many funds and projects being built on what crypto actually is. But really understanding and educating people to actually physically run nodes in those networks to actually ensure that these networks operate is really vital.
So I do feel like we as an industry have sort of skipped some of the basics here. We're spending a lot of time talking about trading and what we're going to do and which assets are going to be successful and can we make that trading more effective. But if you get underneath many of these organizations, they're operating like businesses. They claim decentralization, but 96% aren't decentralized. They have teams, they're funded, they're working, but they don't have the fundamentals of a company you would invest in if you were an equity investor. So they're missing customers. They're missing growth, retention, all the things you would be looking at. And unfortunately, for most people who invest in this space right now, we're not looking at that, right? We're looking at trading signals, we're looking at technicals, et cetera. And so if this industry is too mature, people are going to have to start paying attention to, well, which of these networks are actually growing customers, which of them are going to succeed because they're actually running a business. So as an example, take an asset like Horizon, which I don't know if anyone knows Horizon, but Horizon is this side chain that delivers financial factoring to a whole bunch of companies, some major companies. And if you look at their customer growth, they have real customers doing things to grow over time, and their asset has gone from $3 to $10, and it continues to grow right in alignment with their customers. Okay? If you take many of the companies we talk to, the first thing they say to us, we call them and we say, we can help you understand your customers. There is like a gasp on the phone. And they're like, well, we don't have any customers. We've got this cool technology that we're going to tell you about. And there's a white paper and there's a team. Okay, and so I look at this room and I'm like, you guys, this is great. We're going to build an industry, regulation will solve it. But like, let's start having the real conversation here and focus on which of these folks are driving real business with real customers. Otherwise, we won't be here in 10 years. So I'm sorry to get emotional, but let's do it. Let's do it. Come on. Yeah, let's do it.
Great point, and I think that that's actually a great segue into the next question, which is more like we've got cypherpunky shouting from rooftops, decentralization. When you think about financial markets, what's the perspective from the panel of where do we need blockchains and where don't we? When does decentralization just end up being a very, very slow database? Where does it make sense to have it, and where is it just kind of superfluous and unnecessary?
I mean, I can start just because we're in the business of running a lot of nodes and data centers and coordinating them. I think decentralization as a term is misunderstood a little bit. It's really more a philosophy that changes over time and life cycle of network. And so the way we think of it is when you have a protocol, initially when you want to build it, it's okay to be centralized because you need to ensure that the core functions of the network get properly tested, built out, and so that the network can actually scale without too much technical debt. A lot of the problems in the early day blockchains we've seen that started with more rigorous decentralization is that you have, let's call it technical debt in terms of the open source community that sits around it, which is very, very hard to fix. Ethereum is a good example of that, where, it's tough to actually get changes into the chain that solve some of the core infrastructure problems that they have. And so I think, decentralization works to a degree at the right stage of what it looks like. You don't need decentralization for simple transactions, for example, simply because that's not where the core function of the blockchain lies. And so I think for us there's also a lot of hierarchies of nodes. So ultimately what we see is that there's going to be some truth type of chains like Bitcoin that are fairly heavy. And people can always revert back to that. But then on the layer 2 side, you can have really fast-tracked transaction tooling where decentralization is really more an issue of can any one single party kill a particular market. But for physical applications, as you said, like a physical distributed database can exist without a blockchain and has ups and downs. But it's kind of sort of a weird conversation because it's really not overly relevant for a lot of things you need, but for the core stuff of trust, it is.
So I'll answer the question two ways. There's this very high level that I think all of us are used to hearing about where blockchains are useful, right? In environments where trustlessness is important, in environments where immutability is important, in environments where having a distributed or decentralized network is important or adds value to the use case, and that's all good. But I think it's more important to talk about what I've actually observed in terms of using the blockchain in ways that advantage our firm. There's three primary ways that's played out for us. The first is in terms of compliance. We do real-time AML monitoring of the blockchain, of all the wallets we interact with and the wallets that those interact with. That's really important, of course, to have any strong compliance department, and it's one thing that we've actually enacted and are utilizing the blockchain actively for. Second thing, I have mentioned the L word, liquidity, and I'll probably keep talking about it throughout the course of this panel. I apologize for that. But we actually take a look on-chain at, so how do we get good at monitoring liquidity? I've mentioned already, liquidity in this space is fragmented and it's emergent, right? There are always new sources popping up left or right. And if my job is to provide the best price for any institutional sized trade, I always need to be on top of that. So when I see a client of mine interacting with a new wallet on a consistent basis, and some clients in this room might have gotten this phone call from me, I'll say, hey, I noticed you're doing a lot of transactions with a new venue. Can you tell me a little bit more about them and whether or not we should be tapping in order to be able to provide you better pricing, right? So we are actively monitoring on-chain liquidity sources and using that to drive business decisions around where we should be plugged into and sourcing our liquidity from. Third, operations, and this is something that I think Arwen's making a lot of great progress in. Our operations team is empowered in ways that they fundamentally cannot be in traditional finance when it comes to trade settlement, for example, just to give you one example. So today, if I'm looking, if I'm Goldman Sachs, and I'm looking to hedge fund number one needs the assets right now, and hedge fund number two needs the assets maybe tomorrow, right? And I'm past the wire cutoff. I'm gonna have to do a lot of finagling to get the person that needs the assets their money. However, using the blockchain, there's actually a whole network of participants, the miners, that I can simply increase the gas that I'm paying them such that the payment moves along faster to the client that needs it right now versus the client that doesn't need it now. It's a way our operations team actually works to improve our CSAT, which is meaningfully higher than it is at traditional brokerages. People love yelling at their brokers, but hopefully they don't do it as much for us. But it's a way our operations team has meaningfully used the blockchain in order to improve the customer experience working with our brokerage.
So I think the regulations always force companies to behave in certain ways. So if you look at the crypto exchanges that got the MTL licensing or set up as a trust, everything is in-house under one umbrella, and so the company is doing their own compliance, they're doing their own custody, and they have the exchange, and they're servicing clients. In the world of securities, there's probably 20 different licenses that you can have for different activities. And so fortunately for us, the world of securities is forcing the tech to be more decentralized. And a couple examples of that are with the custody of the security tokens. So we made the first, and it's still the only custody solution for security tokens, a cold storage multi-sig wallet, where our clients and the issuer has all of the keys, and so that they can custody their own securities if they need to and administer them. And then we had to make the standard because as the token is transferring, it has to remain in compliance as well. And so we allow for the free peer-to-peer transfer, but the restrictions are baked in. It's called ERC 1404. It's at erc1404.org. And so like I mentioned earlier, we can authorize every individual and entity after they go through investor onboarding procedures or entity onboarding procedures to hold the token. When you have a list of addresses and linked identities, you can also do things like run AML and OFAC checks in real time. And if there's an issue, you can freeze the tokens that are in that person's wallet. And it's the first time that we've been able to have that transparency and be able to do something like that. We can also force a certain country not trade with another country if the regulations don't permit cross-border transfer. Other things are we can also prevent a single individual or entity from acquiring over a certain percentage of the outstanding securities. So in the smart contract, we can say that none of these addresses should have anything over 5% of the outstanding tokens. And so you sort of have like a preventative poison pill. And I think these are some of the things that wouldn't be possible if we didn't have smart contracts and the blockchain to enable it.
So pretty much wrapping up here. I know we only got a few minutes left. So thinking about, in the same way that what the Volt team and CMT are doing in terms of helping to drive the narrative, when we look at the next wave of adoption, I think even Peter from BitGo was saying this earlier in terms of, we're still kind of in this echo chamber. We're still kind of talking to a similar audience with kind of small increases. What's going to drive the next wave, whether it's a consumer or institutional application? Is it a regulatory challenge? Or if you want to take the answer in a different direction, we've got entrepreneurs all in this panel here. What would be the business that you would start tomorrow to really start to push more adoption if it wasn't your own?
Well, I think
Put you on the spot.
Well, I think one of the key things that are really important is to look at like what companies like Square are doing. So kind of sort of mainstream cash-centric applications using actual blockchain components, and so that's going to be really interesting to see how that sort of scales up. I think the other area that I think shifts and changes. Obviously, Libra set up a good example of a use case that's relevant, which is banking the unbanked. Libra probably isn't the right way to achieve that, but there's projects like Cielo. I don't know if anyone's familiar here with that. It's probably one of the projects we're really excited about. It's a mobile payment application, heavily backed by Andreessen, Polychain, all the largest sort of investors in the space, and it solves a real use case that can be actually where blockchain actually offers real benefits. And so I think that those are the type of projects that we're really excited about, to actually physically provide solutions that currently don't exist, right? So instead of trying to focus, sort of fine-tuning something that actually functions quite well for the current market, is sort of kind of where are the sort of market positions where there is actually currently no solution in it.
So I think this room is talking primarily about the finance side, which is great. I'll tell you one story just to think about what the blockchain is capable of. We, for a long time, had been trying to recruit a guy to our company by the name of Matt Bridges. Matt had built a few companies, ended up at Accenture, and was managing director of a unit. And I tried to recruit him to come in and be our COO, and he politely declined. And I spent a few more months on him. He politely declined. So I had 2 no's. And about a month after that, on a Sunday night, he calls and he says, "I'm in." And I'm like, "Oh, okay." I was so caught off guard. I didn't know what to say, whatever. Anyway, I pretend like I know what's happening. He shows up eventually. And on the first day, I say, "Matt, what happened? Like, why? I mean, I couldn't get you to say yes. What happened?" He said, "Well, over the weekend, I went into Accenture's database and I started looking at what they were doing in the blockchain. And every single company that we worked with was doing a pilot, central banking, aviation, everything. And many of them were moving out of pilot phase into actually using the blockchain to run their business." And so that was my moment where I'm like, holy shit, this isn't like a bunch of people trading on speculation. This is real stuff that is going to change how our economy works. Okay, so while I'm excited about what's happening in DeFi and all the finance side of this, what this will change in someone being able to take a shipping container that takes, from point A to point B, $100 of money and then a whole bunch of time to turn that into $10 will change how our industries work. And so I would just keep an eye out. There won't be a lightning bolt where we're all like, oh my God, blockchain's here. It is going to fundamentally change everything we touch every day. And that's probably the most exciting thing. We're gonna live in a new world with the blockchain running it.
That's great.
So in the security space, we have this really odd problem that we're dealing with, where so primary issuance you can do. You can just follow existing regulations for your offering. When it comes to these securities or these blockchain-enabled securities being transferred on exchanges. We have ATSs approved for allowing for this, but there are no custodians, and these ATSs need to use third-party custodians, and so this is sort of a roadblock that exists for majority of the projects out there. Arca is an interesting solution where they've merged the traditional world and traditional custodians with the blockchain world, and maybe that's the solution. But a lot of the projects in our space are sort of roadblocked by that. So if I had a magic wand, I would make that possible, license a few custodians, like maybe Gemini or Fidelity, with the broker dealer custody license.
All right. Well, thank you to the panelists. Thank you everybody else for coming out, and that's all from us. Thank you. That's great.